Hello, my name is Evan and welcome to Economics 101, your number one source for everything economics. Today we're going to talk about a surprising development in the U.S. economy as it relates to the jobs. According to the latest report from the Bureau of Labor Statistics, the economy lost 92,000 jobs in February, and the unemployment rate rose to 4.4%. And that's a big shift compared to what economists were expecting. Most analysts predicted the economy would gain around 60,000 jobs, but instead we saw a sharp decline. So in today's video, we're going to break down in a simple way and cover three major topics. Number one being, of course, the latest jobs report and what that actually showed. Number two, why the U.S. economy lost the jobs in the first place in February. And number three, what this could mean for the future of the economy and interest rates. By the end of the video, I want my viewers to clearly understand whether this report is just a temporary setback or a warning sign that the labor market is starting to weaken a little bit. Before we get into the video, please like, share, and subscribe, and let's go ahead and get into it. So every month, the Bureau of Labor Statistics releases one of the most important economic indicators in the United States, the monthly jobs report. For me, this is one of the most, if not the most important report for our economy. We're going to dive more into job reports numbers in later videos, but I wanted to put out a quick video about the recent numbers that we just got back from February. So this report tracks how many jobs were created or lost across the economy, the unemployment rate, and wage growth. And February's numbers were definitely surprising. Instead of adding jobs, employers actually cut 92,000 positions across the economy. At the same time, the unemployment rate ticked up slightly from 4.3% to 4.4%. Now, on the surface of that, 4.4% unemployment is still relatively low compared to historical levels, but the bigger issue here is the trend. Just 1 month earlier, in January, the economy actually added about 126,000 jobs, what made it seem like the labor market was actually pretty good or stabilizing. But February completely reversed the momentum. Another thing that caught a lot of economists' attention is that earlier job numbers were revised downward. And you'll have a lot of revisions when it comes to job reports. And again, we're going to talk about that revisions a little bit more in later videos. But the government revised job estimates for December and January, cutting about 69,000 jobs from previously reported totals. When you combine those revisions with February losses, the labor market suddenly looks a lot weaker than many analysts believed just a few weeks ago. So the next question becomes, where exactly did these job losses happen? We're going to get into exactly where those job losses occurred and which markets and industries. Okay, so the job losses in February were spread across multiple sectors, which is one reason economists are paying attention to this report. Let's break down a few of those, the biggest declines. The first one is going to be in healthcare sector, which is normally one of the strongest sources of job growth in the U.S. Actually, it lost about 28,000 jobs. A big reason for that was you had a large strike involving healthcare workers earlier in the month. Next, you had restaurants and hospitality industry also took a hit, losing about 30,000 jobs. On top of that, you had manufacturing that lost jobs. You had construction employment that fell. Administrative and support services also cut workers. Even transportation and your courier industry reduced hiring. So this wasn't just one isolated sector struggling. It was a broad slowdown across several different industries. There are a few possible reasons behind the slowdown. One factor, and we're going to talk about it briefly, one factor is economic uncertainty. You know, we have a lot of uncertainty going on through our economy right now. Businesses tend to slow hiring when they're unsure about the future, whether that's inflation, global conflicts, or government policy. Another factor is higher interest rates. I'm not going to say higher, but high interest rates. The Federal Reserve raised interest rates over the past few years to control inflation or to help fight inflation. Higher than previous rates make borrowing more expensive, which slows business investments and hiring. Some economists also believe companies are being cautious as they invest in new technologies like AI, which could allow them to operate with fewer workers in the future. In other words, businesses might be trying to figure out how figure out how productive their current workforce can be before hiring more employees. And all of this is happening at a time when the broader economy is facing geopolitical uncertainty and shifting global markets. All right. Now, the big question everyone is asking is simple. Is this the beginning of a major slowdown or just a temporary dip? Now, economists are divided. On one hand, a single month of job losses doesn't automatically mean the economy is heading into a recession or a correction or a downturn. The labor market has been incredibly resilient over the past few years. Even with February's decline, unemployment at 4.4% is still relatively low compared to historical standards. So, but there are a couple warning signs. First, you got your job growth throughout the past year has already been much weaker than in previous years. Second, employers seem to be entering what some economists call a no hire, no fire environment. That means companies aren't necessarily laying off a large number of workers, but they also aren't aggressively hiring either. All right. So businesses may simply be waiting to see how the economy evolves before making, hiring decisions in the future. And of course, then there's the question of interest rates. We're going to get into talking a little bit about interest rates. The Federal Reserve closely watches the labor market when deciding whether to raise or lower rates. Okay, if the job market continues to weaken, it could increase pressure on the Fed to eventually cut their interest rates to support economic growth. But if wage growth and inflation remain strong, policymakers might choose to keep the rates high for a little bit longer. So this job report could play a role in shaping economic policy over the next several months. Just a couple of my final thoughts on everything. The bottom line. The U.S. economy lost 92,000 jobs in February, which was a major surprise because economists were expecting some job growth. The unemployment rate also rose 4.4%, and earlier job numbers were revised downward, making the labor market look weaker than previously thought. However, 1 month of negative data doesn't necessarily mean the economy is headed into a recession. The real story will be what happens over the next few months. If job losses continue, it could signal that the labor market is starting to crack. But if hiring rebounds in the spring, this report might end up being remembered as just a temporary setback. All right? What I want to hear from my audience, from the viewers, do you think the U.S. job market is starting to weaken, or is this just a short-term fluctuation? Drop your thoughts in the comments below, and if you enjoy breaking down economics, markets, financial news in a simple way, make sure to like the video and subscribe to the channel. Thank you for watching, and I'll see you next video.